James Rickards says 24,000. What if it goes a whole hell of a lot higher? Eck Funds just came out and said if the dollar loses its reserve status, meaning the Treasury to me more than anything, and gold replaces it, they see gold going to $180,000. That's Eck. I would say 6,000, 6,500, maybe 7,000, because Jefferies used to be Jefferies Beige, and they were primary distributors for the U.S. Mint and all the major mints. They know gold. They're not in the business anymore, but they know gold. They said 7,000 to 7,500 is before we see a little slowdown. 7,000 maybe. I don't know, 6,500. And if I had to say silver, $175 wouldn't surprise me at all, and probably much higher by the end of the year. But again, I'm not a guess guy, but I wouldn't be surprised to see it.
Financial models are now projecting scenarios in which gold rises far beyond standard forecasts, with some institutional analysts pointing toward a complete monetary reset. While James Rickards anticipates a move to $24,000, Eck Funds has outlined a roadmap to $180,000 per ounce should the U.S. dollar lose its global reserve status. Even conservative estimates from market insiders like Jefferies, who have deep knowledge of U.S. mint operations, suggest a rapid climb to $7,500 before any consolidation. Andy Schectman, president of Miles Franklin, breaks down these historic valuations. This shifting landscape implies that current prices are merely a baseline before a violent repricing event. The outlook for silver is equally explosive, with targets of $175 becoming realistic by year-end. These figures represent not just a bull market, but a fundamental loss of confidence in the Treasury market and the fiat system itself. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Paper currencies have the sustaining power of a melting ice cube. And so did gold and silver really go higher, or did the dollar that we call money really fall further? And I think that's what it is. When you're creating $1 trillion in debt every 100 days, and 1 trillion seconds ago was 31,688 years ago, when the world no longer trusts dollars, no longer trusts treasuries, no longer trusts our institutions, judicial system, electoral system, immigration system, all of these systems, then what is the incentive to hold treasuries and or to hold dollars? There's not. And that's why we're seeing de-dollarization. That's why we're seeing commodities usurping treasuries. That's why we're seeing the dollar lose purchasing power. The world is always burning somewhere, but not to the way that people would frame it at $5,000 gold or $100 silver. It is anti-dollar system. It is the realization that money is gold and silver, and everything else is just credit, as J.P. Morgan said. But yes, I think to a large degree it is at the highest level. You know, there's a whole school of, to Ross Beatty's point, the counter to it, there's a whole school of investment theory called wave theory, right? Condrati of Elliott wave, which is about the masses. The people here are the pimple on the elephant's ass. This is not the masses. The masses are out there. And Condrati of an Elliott wave says it measures the emotions of the public, the herd, from, greed, which turns into exuberance, irrational exuberance, fear, panic, and we're long ways away from the fear side of it with pouring into metals with the public. We're a long way from that top on the retail level. They haven't even really started to run through the door yet. So up there, they see it, they're pre-positioning, but I don't think we're anywhere near that blow-off top because the public is really not participating. Well, the difference between us and Goldman Sachs is that we've been saying this forever, and they keep changing. It's like a moving target. Yeah, 2,000, no 2,400, no 3,000, no 3,100, no, and they keep going higher and higher and higher. At some point, it would just be nice if they said we were wrong. And they have been wrong. And you look at the S&P 500 up under 20% in the midst of the greatest tech boom ever last year. Silver up 150, 7 times it. Gold up almost 80, 4 times it. Where are the advisors who said, don't buy that stuff, it pays no interest? Where are they with the tail between their legs saying, I don't know, you live in Germany. I don't know if you remember Happy Days, the TV show. You remember that?
No, I don't.
There was a TV show, and for your older viewers, they'll remember it. And there was a guy called the Fonz, and he was this leather jacket, motorcycle. He was super cool, and he could never say I was wrong. He would say I was ruh. I was ruh. They can't say the ruh. They can't say they were wrong, and they have been. And the people who have separated themselves from the masses have been right. And this is why I think we all need to trust our gut and our intuition, because we're in uncharted waters, and that speaks, I think, far more clearly than a financial advisor who might have different interests or objectives than you, and maybe has been married to a school of ideology that stocks and mutual funds and bonds are the road to retirement, so they learn more and more about less and less till they know everything about nothing. But what do you know? The CIO, Chief Investment Officer of Morgan Stanley, what did he say? Well, that 60-40 stock bond platform that we've used for 50 years, it's broken. Sell half your bonds and put it into gold. So here at the highest level, which hasn't filtered down, I have an account at Morgan Stanley, and the broker is a good buddy of mine. He wouldn't know gold coin if it fell on his foot. I said, do you know your chief investment officer said sell half your bonds and put half of it into gold? And he said, no. But this is coming from the CIO. It's starting at the top, and the big money who positions before the plebes, they'll get it, but long after the big money is already sitting comfortably in their deck chair. Gold going higher than anyone thinks possible because the goal of this administration is to shed the reserve currency. As crazy as that sounds, the term Triffin's dilemma says you will never have a positive trade surplus if you're the reserve currency. Vice President Vance has talked about it. The knucklehead, Jared Bernstein, one of the goofiest guys I've ever seen in my life, trying to explain how treasuries are created. He was the chief economist for the Biden administration. He did write a report called Dethrone King Dollar, which advocates for losing the reserve status. And there are mechanisms like the Genius Act, which says by January 1st of next year, anytime money moves, it will move via stablecoin. And the stablecoin has to be pegged to Treasury's 90-day maturity or less. The Clarity Act says that, well, that interest is not transferable to me or you, the holder of the stablecoin. The issuer keeps it. USA Tether, their CEO is a man named Bo Hines. That was Trump's crypto czar through August. What has Tether been doing with all of that interest? They have $14 billion in gold right now, which is the largest stockpile in the world outside of central banks. And what does rising gold do? Devalues the dollar. And if Judy Shelton, who was on my show twice, is right, she said Trump told her July 4th of this year, which is the 250th anniversary of the country, he'll peg the back end of the bond market to gold. This is how you bring back manufacturing at zero upfront borrowing costs because you have to pay it in gold down the road, zero coupon bonds. So you have the Genius Act on the front end of the curve. The interest goes into gold, which pushes the price of gold up, depresses the dollar. And if Bo Hines is the CEO, do you think there was a wink, wink, nod, nod that said that gold that you guys are buying is going to be purchased by the U.S. Treasury? If they then back the back end of the bond market, you talk of revaluation. James Rickards says 24,000. What if it goes a whole hell of a lot higher? Eck Funds just came out and said if the dollar loses its reserve status, meaning the Treasury to me more than anything, and gold replaces it, they see gold going to $180,000. That's Van Eck. So imagine you sell a 20-year bond redeemable in $100 million in gold today at $5,000 an ounce. That's a lot of gold, right? 20,000 ounces or whatever. How about at $180,000? Now in 20 years, bang, you just ended up giving 300 times less than you did today. So not only does the dollar get massively devalued, but you can now bring back manufacturing at zero upfront borrowing costs and sell your products at a wickedly devalued dollar. That's what the whole world has done to us. That's how they sold us their goods. The dollar's been stronger than anything. And Triffin's dilemma, in essence, says that the world needs more dollars than we can give them through trade alone. So they end up selling their currency to buy ours. Our dollar goes up against theirs. And so we will always have a trade imbalance no matter what. So the moral of the story is, Kai, I think we are entering into a new monetary system where gold is replacing, in many respects, the Treasury. And that's why I don't think we're in the bubble. I think we are in a new monetary system. And to use old school technical analysis or anything you want to look at that has worked in the past, I don't think it works anymore. And that's what you have to wake up and realize. At least that's what I believe. I don't think weaponizing is the right word. I think the U.S. is letting gold higher letting gold go higher and incentivizing it to go higher to peg it to the bond market, to reshore manufacturing. Look, Ray Dalio just came out and said 60% of the country has a reading proficiency under that of the 6th grade. We're $200 trillion in debt when you add in Medicare, Medicaid, Social Security, government military pensions. We don't make anything, so we're broke, we're insolvent, we're uneducated, we don't make anything. Guess what? Here comes AI just in time to the party to kneecap entry-level jobs and even white-collar jobs like accounting. My son was getting paid 80 grand a year by Price Waterhouse to analyze a real estate investment trust balance sheet. What the hell do they need him for when AI does it like that? So now he's working for me. The point of it is this, is that the world is changing, and if we don't do something, we're dead. We cannot be reliant on the rest of the world for everything we need, from aspirin to aircraft parts. And so we are reshoring manufacturing. How do you do it? You have to shed the reserve status. Triffin's dilemma says so. You have to let the dollar collapse in the face of rising gold. And if you can bring it back at no upfront borrowing and build the manufacturing by pegging it to gold, 0 coupon bonds, and let gold go higher and higher and higher, by the time you pay it off, it's a fraction of what it was when you sold the bond. To me, it just makes so much sense. And I don't know why maybe I'm stupid, Kai. I've said a lot of things on your show that no one ever said. Like, when we started talking about things, I was talking about the BRICS. Yeah. Nobody was. Now it's everywhere. I'm saying this, I hear no one saying it, so either I'm stupid or I'm onto something, or have the courage to say what I believe. It's a little bit of both.
The current gold rally is not a speculative bubble, but the dawn of a new monetary system designed to intentionally shed the US dollar's status as a reserve currency. Utilizing Triffin's dilemma as a policy guide, the administration appears intent on devaluing the currency to reshore domestic manufacturing, a strategy explicitly supported by economic advisors advocating to dethrone King Dollar. This shift is already visible in the crypto sector, where stablecoins are accumulating massive gold stockpiles, effectively acting as a bridge between digital liquidity and hard assets. Financial strategy is pivoting toward a gold-backed reset. If the Treasury pegs the back end of the bond market to gold via 0 coupon bonds, it would incentivize a skyrocketing gold price to minimize real debt repayment costs. In this scenario, VanEck's $180,000 per ounce projection becomes a realistic outcome of a dollar collapse. Institutional insiders are actively positioning for this reset, abandoning the broken 60-40 model in favor of heavy gold allocations. At the same time, the retail public remains oblivious to the intentional liquidation of the old financial order. Let's get back to the interview.
What China is doing right now is setting the stage for the BRICS, and I think they're doing that. They're calling it expansion, internationalization of the yuan to not antagonize Trump. So here's what they're doing. First of all, they are making their digital yuan immediately convertible into gold without going into dollars. That's been done. And you would do that through the Shanghai Metals Exchange, right? When gold leaves China, it has to come out of Hong Kong in order to be exported. So they're expanding they have an expansion plan of their Shanghai Exchange. The first one was just completed in Hong Kong. So let's just play this out. China buys oil using either the M-Bridge or the CIPS, the cross-border payment system, which is both are free from, by the way, M-Bridge and the unit, which we've talked about before, it is now operational. They've traded on it slowly. Don't tell anyone, but it is happening. So they trade with one another over this platform that does not allow for SWIFT interference, digital yuan to buy oil from Saudi Arabia. Saudi Arabia has this digital yuan, but it's now convertible into gold. I don't want to hold it, maybe, bang, we send it back and we get the gold out of Hong Kong through the Shanghai Exchange. But they're expanding their ecosystem multi-jurisdictionally. Guess where vault number 2 is under construction?
Saudi Arabia.
Saudi Arabia, who is also the 5th participant next to China, Hong Kong, Thailand, and the UAE in M-Bridge, a cross-border payment system free from SWIFT. They're building it all throughout, these vaults, all throughout the Belt Road. In Asia, in Africa, in South America. So you trade your local currencies, strengthening your own ecosystems, being responsible for your own monetary ecosystem instead of strengthening the U.S., and then settling imbalances in gold and deliverable in a series of multi-jurisdictional vaults. That is what's happening. And to one step further, the Chinese just signed up the Asian countries, the acronym ASEAN. They are China's largest trading partner by far. They're all the big countries in Southeast Asia. They have 800 million people, twice that of the U.S., 30% of global GDP. They're all settling now across the CIPS or the M-Bridge, And here's the interesting thing. All of these trades, largest trading partner by far, used to be in dollars. Chips away at the settlements value of the dollar. And then when you have all those dollars, you have to hold them in treasuries, right? And earn yield on those dollars instead of let them just sit there. So they would put the excess reserves in treasuries. Now they're buying gold instead, which not only has doubled the performance of the 10-year treasury over the last 25 years. Look at the last 2 or 3. 2 years ago, gold up 40%, the 10-year up 4.5%. Last year, gold up 80%, 10-year up 4%. I mean, and it can't be sanctioned. So all of the money going into gold instead of treasuries massively cuts into the reserve status. If you don't allow yourself to think outside the damn box, you are going to be a victim. You have to see what's happening. And the fact is, you got to listen to Kai Hoffman or me or any of the other people here to see this. And if all you do is watch the mainstream, you may be very well read, but you're reading the wrong stuff. If I had a gun to my head and said, you guess, I would say 6,000, 6,500, maybe 7,000, because Jefferies used to be Jefferies Beige, and they were primary distributors for the U.S. Mint and all the major mints. They know gold. They're not in the business anymore, but they know gold. They said 7,000 to 7,500 is before we see a little slowdown. 7,000 maybe. I don't know, 6,500. And if I had to say silver, $175 wouldn't surprise me at all. And probably much higher by the end of the year. But again, I'm not a guess guy, but I wouldn't be surprised to see it.
China is stealthily constructing a global gold settlement network to underpin the BRICS alliance and internationalize the yuan without openly antagonizing the West. By making the digital yuan immediately convertible into physical gold through an expanding infrastructure of vaults, starting in Hong Kong and extending to Saudi Arabia, Beijing is creating a sanction-proof trade ecosystem along the Belt and Road. This mechanism allows major trading partners such as the ASEAN nations, which represent 30% of global GDP, to settle trade outside the SWIFT system, effectively bypassing the US dollar. As nations rotate excess reserves from underperforming US treasuries into unsanctionable gold, the dollar's reserve status faces severe erosion. This structural shift supports aggressive price targets, with institutional forecasts calling for gold to breach $7,500 and silver to surge past $175 as liquidity drains from Western debt markets accelerate. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.